Hello, Smart Money Tree Podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I'll be your host. So today I'm joined with Lily Vittayarukskul. How you doing today, Lily?
I'm doing really great. It's good to be here.
Good, good. Glad to have you. So for the listeners who aren't familiar with you, tell us a bit about your background.
Yeah, definitely. Interesting background. So, I was really fascinated with aerospace engineering. Some of my work actually got recognized when I was 12, and then took some baby steps to ultimately work at NASA on the robotic side at JPL when I was 16. Went to college early for it. But I know with this particular topic, we navigated a personal long-term care event when I was 16 in my family. Happy to dive in there, and that's what caused me to pivot my career into healthcare. I developed my technical background in genetics and in AI from Berkeley before running several early stage product and engineering companies before founding the business on the top.
Nice, nice. So you have a very well-rounded background, sounds like, and uh, it sounds like you've come down a long way from NASA to genetics to insurance.
We are in a very unsexy space. But what I love to tell my kind of future employees is that it's really sexy if you're just interested in like nuanced things. So there's a lot of nuances in insurance. I find it particularly fascinating, and hopefully I could share a little bit of that today.
Yeah, yeah, we'll definitely dive into the weeds. Long-term care is this really fascinating space that I've been an advisor for 26 years, and I can tell you there are almost nobody in the advisor world who understands or is good at long-term care. And the more I hear about it, the less I want to get involved with it. And at the same time, the greater need there is for people to have it and to understand it. It's just weird dynamic in the wealth management space. So maybe you could tell listeners a little bit about this, about what is long-term care, how does it work? Like give us kind of a primer here.
Yeah, I personally I know that the audience here is more like consumers, not necessarily financial professionals, and they're not exactly researchers as well. And so there's a technical definition that you're going to see if you go online about LTSS. What I like to say is long-term care is essentially needing help with activities that you take for granted when you're young and healthy and independent. It's usually needs that we see our grandparents have or our aging parents have, such as bathing, dressing, eating, toileting, incontinence, and getting in and out of bed. So I kind of pause it there. That's how I focus on long-term care is the needs that you have, and some other folks that you might talk to or other professionals might talk about the care resources you need to kind of help take care of those activities if you can't do them by yourself.
So, the way I mean, I work with a lot of variety of clients, and some of them have plenty of money where I don't know if this comes into play, and some don't have enough money where this they might not be able to afford it. So what's kind of like the ideal person who long-term care would be a good fit for?
Yeah, I personally love that question, just because a lot of folks think about long-term care as that it's just largely a financial question. Like, do you have enough to self-fund, or should you consider kind of more sophisticated financial strategies here? Ideally, the folks that need long-term care planning the most fit within 40 to 60 years old. And I would say they're not the mass affluent, but they're kind of a couple notches above that, usually like upper middle class, where if there was a multi-million dollar hit to them right now, again, that population today, it would be incredibly devastating. They would like that's all of their assets then and there. That's probably the ones that we would make the most impact with today.
So like 2 to 5 million in net worth, is that what you're thinking? Yeah.
2 to 5.
Okay. Yeah, it's interesting. There's so many different ways to approach managing risk, and it's actually something that we as a firm focus on, managing risk. That's one of our value sets we have as a firm is risk management first. And I find that most people don't understand risk, nonetheless, how to manage it. Um, so why do you think long-term care is not more readily used in the insurance or the wealth management industry? Like, why do you think advisors just kind of ignore it?
Yeah, and then if you want to go a step deeper into that, I think about this topic all the time because it just should be talked about more often. And I think about why doesn't the consumer think about it or act on it more? But I'll first start with the financial professionals because when I first started the business, I actually spoke to hundreds of families and they wanted to pay me a lot of money to essentially help them navigate long-term care while they needed care today with their aging parents or with their grandparents. And my investors were yelling at me. My close friends who founded businesses were yelling at me to just, you know how incredible this is? You should go and build exactly for that. Build for the consumers for their immediate pain point. And I took a step back and I realized, I'm going to make a bet here because I think that by helping families at the point of care, that is so important, but it's such a band-aid solution. I couldn't help but feel that we couldn't solve for fundamental outcomes, such as, the financial devastation or the care devastation if you don't actually even have a plan ahead of time. And then that's when I realized, oh, there's a space for this. There's actually financial professionals, such as financial advisors, wealth advisors, who if they are fiduciaries, they are required to have a long-term care conversation because it is one of the highest risks in retirement. When I pivoted and spoke to hundreds, at this point, thousands of these advisors and worked with them, the core theme was two things. The first one was that this topic is really complex and morbid, and I really think I'm going to mess it up. And I don't have the time to actually get trained or upskill to kind of do this appropriately, which is why you have long-term care specialists. So essentially what I hear, from them is one, it's a complex topic. It's not a fun one. You want to build client relationships. And three, three is this topic usually takes a long time to kind of talk about, and I don't know how to have it end to end as well. And so I don't want to look dumb in front of them. So I don't want to do anything on this topic. But I guess, Kirk, I'm curious, what's been your experience with this topic?
Yeah, I mean, my experience was when I started at Payne Weber and I got all my licensing, got my sevens, 65, 63, insurance, life and health. And, you just thrown into the mix and you're just learning whatever you can. And then over time, you just kind of naturally fall into certain niches that you tend to be successful at. Um, and you're constantly getting pitched as an advisor, oh, you should do this for your clients, you should do this. And it's interesting education, but when you really break it down, you can't be everything to everybody. And so, when I see areas like long-term care, I actually had a client in 2004 asked me about it, I think it was. And at the time, we were looking at two carriers that were doing lump sum long-term care policies.
Mhm.
And I think there were only two at the time, at least in Mass, because every state's different. Um, and we looked at them, we talked about it, and I didn't really have a background. I didn't have any resources to talk to. I didn't have anyone who was doing it. Like there's an office of 50 people and no one was doing it. So who do you ask? I don't know. So it just kind of didn't happen. And so I think part of the problem is even though you get educated on it and you take CE credits, some insurance is complicated, and this is one of them. And it requires a lot of understanding of with planning, with cash flows, and I think of insurance a little differently. I think of insurance as where is the margin in my favor? So, for example, if I have a client who is 50 and everyone in their family lives to 60 and they're in good health, getting life insurance is a margin that would be beneficial because the life insurance company doesn't know that, right? They don't know the genetic code. They just know what your medical plan says. So in something like that, I'd say, okay, let's run the numbers. Oh, this is heavily in the client's favor. You should do this because the probability is such that you're gonna make out, right? Um, versus something like I'm going to live too long. It's like, well, okay, where does that work in my favor? Well, annuities. It works in your favor of annuities. So I'm always thinking about like you can't know when somebody's going to die. You can't know the health that they're going to have. You maybe a little bit based on appearances and whether they're healthy or not. But in general, there's only so many things you can know. The only thing you can really predict is genetics. Other than that, you have no insight into when they're going to die. So I look at it as, all right, is there a margin of error in the client's favor that would be beneficial for them to do it? Does it does it offset a potentially known risk, right? Depending on what they want to do. Some people just want to go in a nursing home. Some people want to stay at home. Like everyone's different. Um, but frankly, the other part is because I have a friend who does this, and because I wasn't doing it, so I found somebody, an insurance agent who does this, and I work with him, so he does it. Um, and in talking with him, I feel like every year in the state of Massachusetts, another company leaves. Another company decides, it's not profitable to do this anymore. We're leaving. So they just pick up and leave. They don't do any more policies. And so it makes me wonder, long-term care, is it long-term sustainable, where it's both affordable for somebody to pay and benefit on the back end for the insurance companies to make their spread on it?
I'll answer kind of backwards because I think you mentioned a lot of really fascinating comments. But working backwards, uh, when you price long-term care products and any insurance product well, it should have healthy enough margins to run, a pretty large business like a carrier, for example. And there's a reason why carriers also diversify the types of product lines that they actually have as well, because financial professionals need a diversity of them to manage all the risks that exist. At its core, long-term care is a risk. Where it's not a definitely going to happen, but statistically, on average, every single household is going to go through a serious form of long-term care event that costs, in today's dollars, $250,000 out of pocket. But what that means for a 6-year-old is that it's going to cost them 1.2 million, in the future, or very high, 6 digit. And that is a good chunk of someone's retirement. And so how do you kind of think about that? And you kind of explored it from a sort of market adoption standpoint. And really, it's like the market adoption standpoint, and what is the margin that you like? It's hard to understand what is that margin that of benefit you would get from considering, let's just say, an insurance product versus self-funding on this topic. So I'll kind of start from the market perspective, and feel free to interject here at any time, which is the reason why the space is so small. Largely, what we see fundamentally, and we solved for it, is no one wants to talk about their like morbidity or being sick or mortality for the most part. And it's hard to talk about long-term care because no one wants to talk about, but it's just we only have national averages to work with. I think that when you have your long-term care specialist, your friend that you work with on this topic, or when you gotten a little bit educated on this topic, for several decades, the way the conversation went was, oh, you have a 70% likelihood of needing care. Some specialists might call it 56% for a more serious form of care. That is at 2+ ADL needs. That's where you could go on claim, and that's where an insurance product makes sense. And if you're a female, 3.5 years of care is like statistically on average. And let's look into a nursing home in your area. That's about $10,000. So you do have $350,000 to self-fund or not. And of course, if you're working with a $1 million client, $1.2 million, she's going to say, yeah, of course, I have that much. I don't have to worry about it. Not accounting for um, the fact that it's going to inflate. We see right now, we use, in our system that's going to inflate 5.4%, which is what CMS estimates from an actuarial topo. So that cost is going to grow substantially, but we don't hear financial professionals talking about it from a like, this is actually financially relevant. And two, this is actually personally relevant to you in some way. That's why we designed the system. That's why I love the fact that you said, like, oh, if I could guess a little bit about what their health situation is going to look like, then I could actually start to think about what the financial their financial strategy and like what works within their favor versus doesn't work in their favor. And so that's, what we wanted to do, but really, really precisely so that we can make the event real to them, and we could also get more accurate about the cost as well. So for us, we have over 500 million data points of families that we followed for several decades that already went through a long-term care event. And then we narrowed down where were the most predictive variables that resulted in that long-term care event. And we say, here's your intake form, for your client. Have them fill it out. It's just 3 minutes. And the most predictive factors were your social demographic information, not just health information, yes, but also your financial state. Like whether or not how much wealth you have actually drastically affects what your risk of long-term care is going to look like and how expensive it's actually going to be. But again, all of this didn't exist, before we came into this space and we decided to like innovate on it and actually build out algorithms that could help these financial professionals start to differentiate themselves and probably offer more services in a space where portfolio management is becoming more commoditized.
Yeah, so tell me, I know I've got a bunch of questions. One of them is, I know there's two ways to pay for long-term care. One is kind of a lump sum, like a one payment. Another one is like monthly payments. Is there any advantage to doing one versus the other in your opinion?
I love that question, and I think you're gonna hate my answer, which is there is no one single type of product that's gonna work for a client, and I kind of quickly share why. When we predict someone's trajectory, we actually predict their claim event, essentially. We predict, okay, what age it'll happen at, how long it'll be for, and the progression of care hours, or just how do we solve for those care hours with facility or home. We automatically predict that based on what we know about this person and people that we followed that look like this client sitting in front of you. So we might say, okay, based on, John wanting to live at home, first for about 16 months, we predict that. And then he's going to probably want to go into some form of facility-based care for about 36 months. So that's about 4 years of care. From there, what we then did is I also assumed, oh, the highest leverage vehicles are traditional LTC products. What I got really surprised by when I first entered into space, and I actually did the math, is we uploaded that traditional LTC policy. We looked through the policy dynamics, how it actually functioned, what were the main limitations, whether it's a daily max of home care or it's a daily max of facility-based care, and we mapped it to that predicted claim event that we had for this client based on folks that look like them, and we predict the ROI of that. So for a traditional policy, we actually mapped in, okay, if you bought this policy today and it costs you $400 a month, to pay for it up into your predicted claim age, that's how much investment you're making into it. But how's that policy going to pay out for your claim? So it might look like you're going to be putting in $58,000 total in your lifetime to pay for this policy, and then it's going to pay out $450,000, for example. But then you might look at a lump sum policy, such as those hybrid policies where if you don't use it, there is a guaranteed death benefit, and a large guaranteed death benefit. And if you do use it, there's a minimum guaranteed death benefit. Those are called like hybrid policies. And if you put in what's pretty standard, $100,000 is usually that fixed premium you pay upfront. You don't have to pay premiums into it anymore. That might actually, we've seen cases where it covers $600,000 actually of a predicted claim event instead. So there is no sort of like deep competitiveness almost where the traditional long-term care policies always win out on top. It really depends on the carrier and how they've structured that particular vehicle. Because they're like some carriers, such as Mutual of Omaha, have traditional LTC products, and then you have like Securian or Nationwide that are known for selling asset-based hybrid products. So and even then, the benefits for that client could differ. Like that Securian policy is not going to have the same ROI as that Nationwide policy. So it's the devil's really in the details when you look at the policy details. So for what it's worth, I realize that's where the space fell off the cliff, where that's why, we're not having this conversation because a client might come in to someone like you actually and say, hey, I'm worried about this. We navigated this with my parents. I'm now interested in navigating long-term care. And you're like, well, shoot, what am I, where do I even start? What do I even do? And so that's what the system was designed for, was for folks like you, not for the long-term care specialists, so that you could see the prediction, so that you could upload any insurance product from any carrier. And all of a sudden, in under a minute, like, because this is all real time, this all really matters in terms of the client's experience, you get to see money in and money out for any one of those vehicles, whether they already bought the policy or they haven't, and they're considering it.
Yeah, I think one of the challenges is the numbers. It's complicated. Um, in my experience, there are financial advisors and insurance agents who are very detail oriented and they love numbers. I mean, they would geek out on numbers all day. But them explaining that to a client is like, it's like speaking another language. Like it's just clients just don't care. They want to know, am I going to be okay?
Yeah.
They don't want to know all the math behind it. Some do, but most don't. Most they're like, all right, I came here to get a problem solved, not to get my law degree or my doctor, my doctor's degree. I don't need that. I just need, I need a product to solve my problem. And and then there's the other people in the industry who are not numbers people, and they're just like, right over my head. Like I don't know how to do this. And I think that's part of the challenge that I've seen. And it's not just long-term care. There's a bunch of other products that this fits as well, where people tend to overcomplicate it. One of the challenges I've seen in the insurance industry is that many products are so complicated that they overcomplicate it so that people don't understand what they're getting. And I'm not talking long-term care. I'm saying most insurance products. They overcomplicate it. And I've had some policies that the clients brought to me and said, "Hey, what's this about?" I was like, "I don't know." They call the wholesaler. So I call the wholesaler, say, "What is this product that this client owns?" And I didn't sell it to them. Somebody else did. So I'm like, "Well, what is this product?" And they try to explain it. I'm like, "Yeah, but I'm reading the document here and it says this." No, 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 it's that. I'm like, "Well, that's not what it says. It says this." And it's like I don't even know if they know what it
Yep.
means. They just have their talk track. So um I guess the technical term is a confusopoly. So insurance, healthcare, uh, college education, they're confusopolies.
Mhm.
Financial services, where they're deliberately designed to be so confusing that people don't understand what they're getting. So it's hard to compare A to B as typically in commoditized spaces. So um, how should advisors or individuals assess one versus another? Like, how do they know this is a good policy, this isn't a good policy?
Um, I think that's a really fantastic question. Um, I kind of don't look at it in terms of like which is the best policy I could find. I actually look at it probably similar philosophy to you, which is like what is even the margin to even consider a policy, for example. Like if I were to self-fund for this event, great, let's walk through that exercise. Like what are you pulling it from a brokerage account? Are you pulling from a Roth IRA? Like if this risk were to happen, where's that money coming from? And oh, how is that money growing? Or are you still contributing to that account? How's that growing over time? And then account for any tax rate, on that. So we know the efficiency of that vehicle. Okay, what are we going to end up with? So you could actually do that pretty quick. I would say pretty quickly with self-funding any sort of risk. And then from there, I think kind of the next best thing an advisor could do is just if you find a policy where you do learn the terms or and you know where they are on the page, and of course there is support for this. It's just not oh, it's roughly how it works. Like, no, some of us, like, it makes sense when you say, like, hey, broker, like, tell me the term, tell me what page it's on, so I could actually even do the math because it should be um close to simpler to like comparing it to self-funding if you get told, okay, here are the terms, here's roughly how they work. And if those terms map out in such a way where the ROI is higher, then I think that we're going into this positive margin space. So that's like kind of like the first hump we have to get through is a lot of people say, oh, buy insurance no matter what. And I just don't agree with that. I think that if you're going to self-fund, let's see how competitive that is. And then let's consider an insurance vehicle. Is that going to have higher ROI than self-funding or not? People naturally already think about this. And it's because long-term care is such a fascinating health event where it's not like traditional health insurance where we pay a boatload of money every single month, variable premium for a risk that we're likely going to never have, like cancer or kind of breaking our leg or something like that. And we're like, yeah, I'll pay that premium. But when it comes to long-term care, where it's a more definite risk, it's way more likely to happen. And people scoff at purchasing a policy. It's because inherently they think, oh, it's so far in advance that I could self-fund for this. I think that I could beat, what this vehicle is going to give me this offer. So let's look at the offer details.
Yeah, no, I agree with that. I think people tend to overestimate what they can do. And, I think a lot of people in this area, it's kind of like estate planning. I
Mhm.
have a lot of clients, we always talk about estate planning, and it just stuff doesn't get done. You talk about it, they get it, they're on the same page. You should do all these things. And then crickets. Did you do it? Nope. All right. What's the next step? You gotta call the attorney. Okay. 2 weeks later, nope, haven't called the attorney. Like just one of those things like, death and taxes are two things people don't want to talk about. So it's weird in that, you're talking about an inevitable, like I'm going to be sitting here drooling and I need someone to pick up my drool. Like no one wants to think that way. No one wants to, everyone thinks that they're, invulnerable and, they're Superman or Superwoman and they're never going to get old or infirmed. But reality is everyone does unless they die early. So it's an interesting conversation for sure. Now you mentioned earlier that you changed in this industry because of stuff that happened in your life. So I don't know if you are willing to share, but I'd love to hear your story about why you kind of dove into this space.
Yeah, absolutely. I appreciate you sharing that just because when people are born, they don't immediately think, I want to go into the long-term care insurance industry. For me, when I was more in a fast track trajectory in the aerospace industry. That's a space that I really loved. But when I was 16, my aunt, who was a really integral part of our first generation immigrant family, she helped raise me growing up. She was essentially my second mom. She was diagnosed with terminal stage colon cancer. And what came with that was 2.5 years of a very serious long-term care event where we had to navigate her daily long-term care needs for 2.5 years. And we did it within our household. And it was so devastating for us. One is because a lot of folks assume when you don't talk about this topic, oh, that my health insurance, my traditional health insurance is going to cover this, whether it's Medicare or whatever else. And it's not true. And so we paid anything and everything for her care, and we weren't wealthy by any means. And we nearly bankrupt ourselves just paying for that care. And that's just separate from taking on the burden. And it's a lot, it's logistically a lot of work to do. And I'm not even going to say that that's the most devastating aspect. The most devastating aspect that made me pivot my career, from this fast track was the fact that we didn't have a care plan in place and it broke up our family relationships. It really broke up the quality of the relationships we had because we had to make all these high stakes decisions about who's going to come in. So the emotional state was high. The stakes were high about what the best form of care for her would look like. Is it facility or is it being at the home? And the fights got so bad that we hadn't spoken to our entire the entire extended side of our family on my mom and aunt side in over a decade since that event has happened. And that really broke my mom. And I just saw all that and I just saw how there's so much pain and misunderstanding. And I wasn't alone in this. Every household that I interviewed had the same DNA of devastation as well. So that's what got me into the space. And I think that's the main thing that people miss when it comes to this topic is, and I think that really fantastic advisors are understanding, I think, through our innovation, which is it's not just about like just the positive margin you're going to earn on a potential risk, but it's actually about protecting your family members from this topic. If you do build out that plan ahead of time, you're actually protecting your legacy. For us, uh, for the system, what was really important for me and absolutely by far the hardest algorithms I've ever built that the life insurance space has never seen before is we predict how much the family members step in by default to take on that care if you don't build out a care plan. So we actually predict for Jane, the daughter in this case, we predict, oh, if you're going to start to age at the home, it'll start with 14 hours per week, but then it'll grow into 20 hours per week, then it'll grow to 40 hours per week. And then when a client sees that, they completely understand what that looks like. We've made it very apparent to them and they realize, oh my God, I realize it's not about being comfortable when I'm old. It's actually about the fact that I don't want my daughter, who has her own family, her own household, to step away from her job or step away from her kids to take care of me. So, how much is it going to cost for me to have that peace of mind? And what's harder with people who self-fund, and I'll kind of just dive this as the last piece, is what I've seen as a phenomena is you can't decide to self-fund. It might end up having the more positive margin. Statistically, I have not seen it be in that case when you do it the right way. Um, is that oftentimes they just don't part ways with that money. They might say like, oh yeah, I could self-fund for this, but by the time they need care, they're like, I'm not touching that money. I'm really scared that I'm gonna, lose that money. I'm gonna lose a house or whatever else. So it's just psychologically not talking about it just creates a drastically worse quality of life. So that's why if you want to self-fund, totally fine, but build an actual plan around that.
Yeah, I appreciate you sharing your story because there's so many parts of that. I talk about this a lot with clients. I talk about this with my family. It's like, the caretaker role, right? And one of the parents gets old and they can't take care of themselves. Who's going to take care of them? Is it going to be you? Is it going to be me? Like who's it going to be? And it's nice to think, oh, I'll take care of them. It'll be great, but that's only because they don't know what's involved. Um, I find that from working with a lot of clients over the years, the caretaker, what tends to happen is the person who's the caretaker ends up not taking care of themselves. And, their health deteriorates, their quality of life deteriorates because they're giving 100% of themselves to the other person, which there's nothing wrong with that. But the problem is then you're not taking care of yourself. So now two people are going down, right? And so it's obviously a personal decision. I've seen clients take care of their, aunt, uncle, mother, father, whatever. Um, and at some point they realize I can't do this anymore. Like this is my quality of life is deteriorating. I need help. So either they put them in a home or they get an in-home person or whatever they do as a solution. Um, so it's nice to think that you can kind of do it all, but the reality is for most people, as much as you want to, it's a big burden. Like I think about my dad, he's passed now, but like I think about like if I had to take care of him, I mean, he was a bull in a china shop. Like there was no way and I would happily do it, but there's no way anyone could take care of him. He was just a very strong personality, and he clearly shouldn't have been driving a car, but yet he was driving a car and doing whatever he wanted. And I think that's hard when people age is giving up autonomy, admitting the fact that you're getting old, and you have people that want to help that clearly understand what's going on, and you don't want to give it up because you're like, nope, I'm doing this, and that's the way it is, and it's all, it's their ego kicking in. And I think of it as, the lifespan. It's like you got a little baby, can't take care of themselves. It's like a plant. You give it love and water, and that's about it. Like it doesn't move. And as they kind of go up the curve, they get more autonomous, they get more, independent. And then at some point that starts to go down, and then they become a baby again, right? They can't change their diaper, they can't feed themselves, they can't get around. Like it just kind of inverts, and the difference in the baby and the old person is the baby doesn't know any better. The old person does. And so they don't want to allow themselves to go down that road. And it's hard. You can't have the conversation because they have to admit the fact that they're getting old. And I don't know about you, but the baby boomers or the matures, the ones before the boomers, it's all ego. They're not going to admit that. Like I'll admit it because it's just our generation's a little different, but no, they will absolutely not admit that. You couldn't pull it out of them. So I appreciate you sharing the story. How should people because sometimes it's not always just the person, sometimes it's a family member that is determining whether this works or not. So, how would you advise people to have the conversation? Who needs to be involved? Who should be making the decisions? At what point in long-term care does another person in the family need to be involved?
I think that's a one is like I can't tell you the countless stories that I've heard that it's very much exactly what you said about, I have a parent and there's just like no way that you could actually change their opinion and they also don't want to talk about it. And like there's that fundamental like difference. I think things are looking really different for, I would say, our next few generations that are actually aging, such as our baby boomers. I think there's COVID that makes us more aware of our mortality and morbidity than we expected. And we're kind of a part of the electronic generation where you have online communities. We're way more open to talking about it. And it is for our benefit. It has huge financial implications and huge quality of life implications. And we see that and we're trying to be smarter about it. And so one is like the key, like what I found to be like such a good kind of first step is if there is a professional that you can talk to involved in the topic, whether it's an estate planner or financial professional or care professional, um, talk to them. I would say like if you talk to them about it, what I love about it is that it evens out the psychological kind of ground a little bit. There is no kind of assumption, there is no judgment about, what your preferences look like. So being able to first talk to that person about like, hey, if I were to start needing care in some way, how long do I want to be at the home? At what point do I potentially want to go into facility-based care? Do I have the money for it? And if you do want to age at the home, naturally then you should talk about how could that affect your family members. Oftentimes this might fall on your spouse. This would definitely fall on your spouse. If you have a spouse, you definitely talk to them about this topic. I think it is going to directly affect them no matter what. But then you have your children. And it's really helpful to have a conversation with them about it, probably once you get the bearings yourself to kind of like, I think I roughly want this, and if I have enough financially, then it's only more of a conversation of, who could you trust to make smart decisions for you financially and care-wise on your behalf if you can no longer do that. But if you don't have the financial means, you find that like, hey, I'm cutting it really close, whatever I decide, then having a deeper conversation with your children about like, hey, I'm trying to be responsible here. I'm trying to map out like my finances. I worry that I may or may not have enough. I think I'm going to try to consider insurance or I'm going to try to, self-fund for this event. But I do have a little bit of, a deficit. So I wanted to ask if you think you'd be open to some minimal care, for me if I were to need it in the future, and how can I make it as easy as possible for you? And usually, if you do that, the children would say instead, well, what's that gap? I want to pay for it because I just can't move away from my job, something like that. So I think starting with yourself and a professional, I think is a non-judgment way to kind of go about it. Involving your spouse in that is probably mandatory, whether it's on the front end or tail end. And no matter what, you're gonna, I think, involve your kids anyways, because they're going to be the more able-bodied individuals to make decisions for you when you might not be able to yourself at that time.
So one of my friends is an advisor, and he focuses on child-free folk, couples without kids. And apparently, that's a growing population. Um, how important is long-term care for people who don't have children versus people who do? Because obviously, having those multi-generations, you got more people that could potentially help. But how would you kind of look at that?
Yeah, I would say if you decide, I'll break it up into kind of two parts. The first one is like logistically. If you don't have children to step in to help for you, like two things can happen. One is like you might have non-children who may want to, who you're going to try to rely on, whether it's a niece or a nephew, especially they might end up being the power of attorney in this case because you trust them, you built a relationship with them. There is just someone that you want to rely on that you want to, that in your family to make decisions, and they may step in logistically for you if you have no plan in place, if that relationship is deep enough. On the other side is if they can't step in logistically, that's a difference of hundreds of thousands of dollars of you have to somehow find that money to have professionals step in and take care for you instead. It could be in the low hundreds of thousands, it could be in the high hundreds of thousands. So for child-free folks, that is financially something they should consider if they're not logistically relying on, a non-child, but a different type of family member to step in for their care. Um, I think I kind of I guess those are the two pieces, if that sort of makes sense.
Yeah,
Um,
yeah,
yeah.
absolutely. Cool. So we'll kind of wrap it up here in the interest of time. We're running up against the clock. So Lily, appreciate you coming to the show. What final thoughts can you leave our listeners with, and where can people find more about you?
Yeah, absolutely. The first one, the main thought I want to share is long-term care is statistically going to hit every single household at least once in a really serious way. It is a very serious risk for you to talk about. And if you're in your 40s to 60s, that's really the ideal time in which once you kind of do the research on this topic, you're also going to find the highest leverage financial vehicles here, where spending, $50,000 or $100,000 could lead to $1 million in coverage or $600,000 in coverage. And the longer you wait, especially after 60, that leverage drops off pretty substantially in vehicles that exist in this space. Um, that is really hard to estimate. both your needs, and it's hard to estimate, a product. And I normally don't recommend go buy a product no matter what, anyways, because the type of product matters. And so that's why we designed Water Lily. It's for that financial professional, it's for that care professional to help any client, any family sitting in front of them learn what their unique long-term care trajectory is going to look like, the associated costs, and help them build out a sustainable care and financial plan. And it's all linear and kind of like step by step by step so that it's not overwhelming. So you can find us at waterlily.com. You could sign up onto our wait list. I personally take on 1 out of every 10 consumers that join our wait list. And I eat my own cooking. I actually help serve them myself so I could learn how to better help this situation. And for professionals, it's $59 per month for you to just use this with your clients.
Nice. Awesome. Well, Lily, I really appreciate you joining us. Glad we got a chance to dip into this topic. We don't talk about it very much because it's hard to find smart people. So I appreciate you kind of sharing your wisdom with us. So thanks for coming on the show, and yeah, we'll probably talk in the future.
Hey, Doug, did you hear? We're giving away free money. Well, I'll tell you about it in a minute, but before I do, there's a saying in the mining community, well, precious metals mining, that is. The saying is that if you want the best deals, you have to be in the room. Now, you're probably thinking, what does it mean to be in the room? Well, I'll tell you. Being in the room means that you're on the short list of people who get invited to be a part of the best deals. These are the deals that most investors will never have access to. You mean like IPOs? Nope, IPOs are chump change. Those are for retail investors, small potatoes. That's nothing compared to these deals. These deals would have you salivating to get access to them. Once you know they exist, you will never look at investing the same way again. I almost don't want to even tell you that they exist because it will ruin your thinking of how the investing world really works. Now, you might be excited that these deals exist, but you only have access to the deals if you're an insider, or in the room as they call it. Now, as loyal listeners to the show, I'm going to give you a chance to be in the room. Money Tree Investing Podcast has created the Insiders Club. This is a community of our show's members who are loyal listeners of the show and want to get more out of their investing experience. Being a part of the Insiders Club gives you insider status for upcoming events and webinars, discounts, free stuff and books, and influence on the future direction of the show. This is a great opportunity to join us as we expand our content and services. Oh, and did I mention free money? Yes, in the next few weeks, I'll be giving away free money to our members of the Insiders Club as my appreciation for listening to the show. Now, there's no cost to join the Insiders Club. Just go to moneytreepodcast.com/free money today to join the community. That's www.moneytreepodcast.com/free money. I hope to see you in the room. All right, that was a great interview with Lily. Appreciate her coming on the show. Now we're into the panel portion of the show where we have our very own Barb Freeberg. Hey, Barb.
Hello, everybody. Happy to be here.
Glad to have you. And we also have our very own Doug Hagren. Hey, Doug.
Good morning, Kirk. Good to see you again.
Yeah, good to have you both. So, Barb, what were some of your takeaways from the interview?
Well, this is really an issue for me because my husband and I just stopped paying our long-term care premiums, which we have had for probably 10 or 15 years, because they got so expensive that we thought, this is so much money to pay out each year for care we probably will not need or might not need. But it raised so much. And the thing I want to focus on is the likelihood that most of us are going to need long-term care versus all the other types of insurance we have, our auto insurance, liability, our homeowners. We're probably never going to have a catastrophic loss in those. The likelihood is we're going to need long-term care. And on another note, all of our parents have had some sort of long-term care. So it stands up in our family, and they were all relatively healthy.
Yeah, it's scary how expensive it is when you're healthy. That's for sure. But Doug, what about you? What are some of your thoughts?
Well, this topic hits home. I mean, I spend my days working with families who, think they're planning for the future, but long-term care is the one blind spot most of them pretend doesn't exist. I mean, it's like financial dark matter. It's invisible until it starts pulling everything else apart. My biggest takeaway is, as I've said in the college planning, this isn't a product issue. It's a planning failure issue. And I love how Lily talks about of advisors, just like they do with college planning, they're avoiding this because they don't know what to do about it. And that's a real detriment to their clients. I mean, I like what Lily's doing with Water Lily is finally putting more data behind something that they've been winging for decades. Now, I haven't been winging. I work on this regularly. But the first wave of long-term care insurance failed because it underestimated the cost of human fragility, longevity, cognitive decline, inflation. The math was wrong. And, AI is they're using AI to start to fix that. And what I see on the ground with my Gen X clients, they're the sandwich generation. They're raising kids, they're caring for parents, they're trying to retire, they're terrified of becoming the burden that they're dealing with now. And that's why this conversation really matters to me. And the truth is, about one out of every two or one out of every three people will need some kind of care. So it's not just about survival, it's about independence, it's about affordability. And the biggest one I think of that is it's about dignity. And if you don't plan for those three things, someone else is going to end up deciding them for you. And that's usually not the outcome that people want. So for me, the takeaway isn't fear, it's clarity. Long-term care planning is really about protecting income, preserving legacy, and keeping families from fracturing under stress. And her data just gives the proof that many of us have been preaching for years.
Yeah, no, appreciate that. So let's dive in the weeds a little bit because I know both of you have different perspectives on long-term care. But Barb, what's some of your experience dealing with long-term care? How should people be thinking about it?
Well, I think Lily pointed up one of the biggest barriers, which is it is so freaking complicated that it's really hard to do the value calculations. Now, I have done that myself using some estimates myself to kind of figure out the cost benefit, but I love that she has an actual algorithm that can really do the numbers for you, because if you can look at likelihood, probability that you will need it, probability of what it will cost, given many, many factors, and which solution allows you to come out ahead, it makes the decision making so much easier. But that information is very, very, very difficult to come by. And I haven't explored her product yet, so I don't want to give it a yay or a nay or whatever. But just from the interview, it sounds like she is filling a niche that is really important, and that is adding a little transparency to what is a very complicated issue.
Yeah, I couldn't agree more. Doug, you obviously have more experience in this area with the product side. So, what are some of your thoughts?
So I'm going to start by saying this. What Lily's doing, it isn't new. Okay. Financial planning tools have been out there addressing this for a long, long time. It's just, unfortunately, it's, as I said, it's not a product issue. It's a planning issue. Advisors treat long-term care like the dental work of wealth management. I mean, they know it's necessary, but they'd rather avoid it. And the irony is it's one conversation that can save families' finances and their relationships. The need is universal. Every household will face a serious long-term care event. Now, maybe not between the husband and the wife, but somewhere. And the average out-of-pocket today is approximately $250,000. And if we look forward, it's projecting to 1.2 million for today's 60-year-olds. The ideal planning window, it's between ages 40 and 60. That's ideal, so it's never too late. And some people do like to get it earlier. And so again, that's the Gen X sandwich generation. They've been caught between aging parents and launching kids. The conversation, let's be frank, why most advisors avoid it, I think it's a combination of lazy, because again, sometimes easier to make money on just simple things like, hey, I've got your investments and I get this, this money regularly. And Kirk, you know this. A lot of people, a lot of advisors, they they get paid off investments. They're not really managing those, and they're certainly not giving any other value advice outside of it. There's a very big difference between true active investment oversight, like the stuff you're doing, and what a lot of advisors do. But the other side is that it's uncomfortable, it's complex, it's morbid, it's time consuming. These are three things that most wealth advisors avoid, which comes back to the lazy part, but also the fear of looking dumb in front of clients because the product landscape is confusing. The math's opaque. Carriers keep exiting the market. Now, what her product's doing, it's predicting age, duration, and cost of a likely LTC event. Like I said, it's not the only thing out there doing it. I see it as kind of a fringe planning tool in a suite. And it calculates ROI by comparing self-funding versus insurance versus hybrid, which is great. That part is a little bit unique there. And I know a lot about all three of these things. It integrates demographics, social factors, level, and it actually recognizes affluence increases the LTC cost because wealthier people, they tend to want to buy higher quality care. I hear a pattern here. College planning. Affluence actually raises college costs. Same reason. They have more money. They want nicer things. Now, I started in this, working with this 10, 15 years ago. And some of the old school LTC products, it started with one of the original was Fireman's Fund. That ended up becoming part of IDS, which then became Ameriprise Financial Advisors, and then American Express, sorry, Financial Advisors, and then they spun that out under Genworth, and it failed due to bad actuarial bets and persistent underpricing. The new models, the hybrid ones she talked about, you've got life with LTC riders or LTC linked annuities like 4Care or still some traditional policies out there. They reflect a reality. It's expensive, but sustainable. But there's guaranteed benefit if unused. Generally, under $1 million, the cost of it sometimes is questionable. Now, again, planning is about what you want and solving the problems you want. But there is Medicaid. Okay, it's not ideal. They're going to send you where they want. It's not great, but it is something that is a fallback. Now, when you get above 1 million, generally the old calculations were 1 to 3 million, but with inflation, we're probably looking kind of between 1 and 5 million. That remains the critical zone. It's too wealthy for Medicaid, but not wealthy enough to self-fund comfortably. And that leaves a human toll. This LTC is not just financial, it's emotional erosion. Her family stopped speaking after caregiving battles. The data shows similar family breakdown patterns across many households. For child-free households, the cost delta is massive. No caregiver equals hundreds of thousands more for professional help. I have seen, and there's no perfect science out there. I've seen situations in which multi-million dollar net worth, where one gentleman, a father of one of my clients, he had a stroke. He had 3 full-time Medicare aides working with him. At the rate he was going, he would have burned through well over $1 million in 1 year. Actually, I think we calculated it could have been close to $1.5 million, which would have been more than half of his net worth. Fortunately, financially in his situation, and because of quality of life, he passed away after 3 months, but he'd already burned through somewhere in the range of 400 grand in his situation. He wanted better care, full time. This thing is a massive potential failure in planning if you avoid it.
Yeah. So, one thing that kind of comes up, and I'm curious in your thoughts on this, Barb. Insurance is confusing and drives people away, and the industry is constantly changing. As a consumer and somebody who's obviously got a long history in finance, how do you look at things like insurance? Is it, do you look at it as well? It's essential, or do you really have to get into the weeds in order to see if it makes sense?
I don't think you can compare all insurance because each type of insurance is different. So you have to look, for example, in covering costs that you cannot afford to pay. I mean, that's the real key. If you can afford to pay it, then in many cases, because there's a probability you won't need it, you might want, and if you like have the conditions like you talked about in the interview, Kirk, about, I weigh out the probabilities with my clients. I'm not I'm not a lover of insurance in general, but I think under some circumstances it solves a problem. I think the long-term care insurance should be set apart because the probability is so high that you're going to need it. The probabilities, as I understand it, that you'll get in a car wreck, that your house will burn down, et cetera, those things are slimmer. And for example, you may want to have a bigger deductible on things like your homeowners, so your premiums are lower because the probability that you're going to have a big claim on your home is relatively low. But it's not a one size fits all question. And then you get into things like life insurance. And there is a whole litany of varieties there. And there's a whole litany of uses for life insurance other than just if someone dies, you get money. And I think when you're young and growing up and you've got 2 kids, you get term life insurance. It's cheap and you're covered for if you die. But then the other life insurance alternatives, you have to look out for what are you trying to accomplish? How much does it cost? And what is the commission that you're paying? And are you being sold a product because the seller wants you to have it or because you really need it?
Yeah, no, it's good insight. So Doug, I mean, you work with clients all the time, and you see the product side, you see the individual side, and um, certainly I see it too. But when you're working with people, how would you suggest people think about it? Because in many ways, you're trying to bridge the gap between this complicated product that is, I would say, in many ways, deliberately confusing. Most insurance is designed that way. And a client who clearly needs it, they don't have to have it, but it's clearly going to help them in a major way. How should people try to think about things differently? Because most of us have a bias, like anti-insurance, anti this, anti that, or I'm an indexer, and people have their bias. Like, how do you talk to people to really kind of share this? Because it is kind of this weird product that most people aren't even aware that exists.
Yeah. I'm gonna say this, Frank. I love insurance, and I love it for a number of reasons. My father passed away at 53 years old. He had permanent insurance, he had term insurance. I look at it this way, in a couple pieces. I mean, there's certain, I want to come back to the long-term care. Yes, there is a financial aspect to all this, which we've touched on, but it goes beyond this. First of all, Barb mentioned term insurance. Even that's not so simple. There's lots of term insurance out there. You're basically just paying for a death benefit, like auto insurance. If you don't die, it'll be a pure cost, and it becomes something you're handing your money away. 93% to 97% of all term insurance just expires, and basically you get nothing back for it. That's okay, because when you look at your cash flow and your situation, the risk is something you may want to cover. If you have more money available and more cash flow available, then there becomes other conversation to have, and it really comes around what you want. We always look at it as it's something you need, but this is a needs versus want conversation. I want to just use a couple of options. For example, you don't need to have a car. You could always take public transportation, but most people want to have a car. Like, why? For the other kind of things that it offers for you, the freedom, the independence, just love type driving, etc. You don't need to have an education. You can go to a public school, you can go to community college, you can go to public, education high school. But some people want to have private education for other benefits or things that it offers. And there's lots of stuff these days that have come out about why people are homeschooling or going to private schools for their own, reasons. So there is, you don't even need to have a house. A house is something, again, you could always rent, right? You can find these things, but it's a needs versus want conversation. And in many cases, insurance, especially with life insurance, can be the only thing that ensures that what you want will come true under any circumstance. Okay. So because most people are wildly underinsured, let's go look at GoFundMe. I've seen people you thought, doctors, high incomes, executives, all of a sudden something happens and there's a GoFundMe account for their family. It tells you there was a problem. Okay. So the way I look at this, and let's go back to term insurance. There's actually term insurance, by the way, out there that has triggers and clauses that will pay out for critical care. So that's things like transplants, cancer, etc., or pay out for long-term care or chronic care needs for term insurance. Most people don't know this. They just go out, buy the cheapest thing, and for maybe $10 a month more, they could have had something wildly more usable. Okay. Now, when you start getting into the permanent insurance side, this becomes a different conversation. I want to talk about the three ways to look at long-term care because I've got clients who are constantly from those old failed policies getting annual updates now where they're basically telling them we'll pay you out everything you funded, go away, or we're going to cut or you can cut your benefits to keep your costs down, or we're going to jack your costs up. They failed to price it. It's not really necessarily all their fault. This was such a wild west that they knew it was a risk, they just didn't realize how much. Products came out that said you could pay one-time check and it would be good for life. That's starting to be an issue because now these insurance companies are on the hook for that. So it's now evolved where these more traditional pay-as-you-go, like auto insurance policies, you know, the problem is you get nothing guaranteed for that, and it's extremely expensive. And they're right for what they're charging. They have to. Because, like I said, one out of every two people's filing a claim. You had all of these states go out and create something called partnership programs. That tells you it was a problem. Partnership program was something that was created, started in California, and it was started as something in which the states saw so many people claiming Medicaid that and these were financially well-off families that they went out and said, we'll make you a deal. If you go out and get a traditional long-term care type of a policy, we will allow you to qualify for Medicaid, but keep all of the assets that you have equal to the amount of coverage that you got. And the way the states looked at it is this would push a lot of people to the private policies. And then, of course, if they did exhaust that policy in the extreme cases, then they'd end up on Medicaid. And yes, they would still have cases and they would be affluent cases potentially, but that they normally would have denied for Medicaid. But in this case, they said, look, we've taken so many off of our actuarial risks. And so that drove more people to look to private insurance, but that also skewed the actuarial tables to the number of people then who were claiming it. And again, if one out of two need it, that's a problem. So let's go back to the one side. That meant I don't want it. Some people who could afford it said, I don't want to have something that's just going to be a pit of money I'm throwing into. I may never use this. So that's when, life insurance started to say, you know what? Let's add this as a rider. We're paying you out anyway. We already have the cost. We've already done the numbers. You die, we're going to give you this. So what we'll do is we'll either give you an accelerated benefit and pay you out early if you have this need as another benefit, or they're going to turn around and they would actually add a rider on top of it that was strictly for long-term care. And so that was great, but that takes a lot of cash flow. Like a permanent policy is something where you've got to fund it for your entire life, so it does take more outflow to get into that. So not everybody could afford that. So that's a challenge, right? So that's why, again, these net worth issues matter because you've got to have the cash flow to be able to allocate funds to these things. The thing I love about the permanent side, it's a Swiss Army knife. It's not just for death, long-term care. There's a lot of different things you can use it while you're living. But now they've got these long-term care annuities. Now, these are great for someone that might not have cash flow, might have assets. I've seen people who have inherited things. Maybe a spouse has died. They've got cash. They want to protect themselves, but they don't have the cash flow to necessarily fund into a PIT or life insurance. So now they can put a lump sum up front, and they give really favorable terms, like saying, look, if you have long-term care, One America has a policy like this, Global Atlantic has a policy like this, where if you put 100,000 into it, couple of questions, boom, you're good. They'll give you 300,000 for long-term care. It's a great way. But if you don't use it, it grows. It's cash. It grows at a good interest rate, and your heirs get it. But you still got to be able to allocate that to a purpose that isn't going to necessarily fit. If you need cash flow in your lifetime for retirement, that's not going to work, right? Because you are effectively pushing that to the side for estate and long-term care. So it does take a real assessment of personal individual wants and needs to be able to come up with what's going to be the right option for each one of these families, and that goes a lot deeper in terms of, what's going to be right or how you're going to affect it. And again, there is a need base, but it really comes down to tell me what you want, tell me what your risk is, how important it is to you. And then the concept in this is, all right, fine. Certain products or strategies have certain attributes that solve certain problems. So once you decide that that problem is something you want solved, you go to the shelf and pick what fits there. It doesn't need to get as dry and convoluted as all of these calculations, actuarial or things, and even her product says you need to do. The average person's not going to take action on that. It's way too much data. We as advisors know this. You overwhelm people, they go, ugh, right? So let's just have a simple conversation. What do you want? Boom. That narrows it down. These things have those attributes. Let's talk through it. The most important thing here is conversation. And I want to add one last thing on this before I turn it back is taking this away from financial for a second. Long-term care planning isn't about dying. It's about maintaining, as I said, independence, affording help, and keeping your dignity when your body stops cooperating. These are the three triggers that make people actually act. When I talk to families, generally money isn't the number one reason that they think of long-term care, unless they've gone through it and they've seen the bleeding with their family. It's not necessarily their biggest concern. The two biggest concerns are independence. They want to be able to stay in their home. They don't want to be forced to have to sell a house, and you don't always have to sell it for Medicaid, but most of the time, but there are triggers that make you have to sell your house. And then they don't want to be told they have to go to a facility and be stuck someplace. They want to stay at home. And most people are going to trigger long-term care off of either a cognitive, Alzheimer's, dementia, and almost every old person's going to have dementia eventually. It's just aging. And then there's activities of daily living, bathing yourself, eating, getting in and out of bed, washing, those basic things. For most people, two activities of daily living triggers this, but that's not necessarily catastrophic. It's like, I can still live. I just can't get up down my stairs. So maybe it's putting in a little elevator, getting in and out of bed, or getting some help. That's the independence people want. They still want to live and adjust their home. You've seen the 2 a.m. ads. Rip out your bathtub and put in a walk-in bathtub. That could make living in that home for 10 years acceptable. But the biggest one is dignity. Listen, you start as toddlers, we get older, we get independent, we end up as toddlers, unfortunately. And then someone has to take care of us again. And that means, this is a saying I used to say, you're going to need long-term care or not. It depends. Well, depends on the diapers they have to wear. And changing that is disgusting. And so a lot of people would rather have someone who's licensed, a professional. There's a professional relationship coming in to help with those dignity suffocating tasks, then all of a sudden relying on your kids to come and clean up after you've soiled yourself. That to me is one of the biggest triggers out there is I want to make sure they don't have to do that, and I don't want to ever have them do that.
Yeah, that's great insight, Doug. Appreciate that, getting from someone who's dealt with this a lot. So, Barb, as we kind of wrap up here, final thoughts from you.
My biggest takeaway is this is not a conversation you should avoid because it's complicated. And it's so easy to do that. I'm actually in a situation where I am a little bit doing that myself. So I'm speaking to you and I'm speaking to myself. So spend a little time exploring solutions for long-term care because it's likely you or your spouse will need it at some time. And I am Barbara Friedberg. Check me out on YouTube and at my website, Barbara Friedberg Personal Finance.
Awesome. Thanks for coming on, Barb. And Doug, final thoughts from you.
Thanks. Long-term care is not an insurance decision. It's an income planning and legacy preservation decision. Smart money, smart affluent families plan on this because they understand three truths. Independence is priceless, dignity is non-negotiable, and risk management isn't optional. We've talked about different things like traditional long-term care, hybrid life policies, LTC-linked annuities. There's more that goes into planning than this. Funding options can also include non-qualified assets, home equity conversion mortgage, a kind of reverse mortgage, Roth conversion timing, medical expense deductions. By the way, I do college planning. If you don't use you know, a lot of people have money in 529s, and sometimes they end up with more money in their 529 than they needed for college. That's a planning issue. New rules allow you to do different things like give it to, you know, your kids as a Roth. But if you have over 7.5% of your annual taxable income as a medical expense, you begin to be able to deduct medical expense deductions, which means that IRAs or 529s, although there still be a 10% penalty, could also be a source of long-term care funding. So there's so much more that needs to go into this. It's ethical and social implications in the future. We're going to be dealing with caregiver labor shortages, aging demographics, government limits, just like college planning, the failure of financial advisors to address this is absolutely catastrophic for clients. And here's what I see on the ground with my Gen X clients specifically. As I said, they're the sandwich generation, raising kids, caring for parents, and still trying to retire as inflation's eating every last dollar. They are terrified of becoming the burden that they're dealing with now, and this conversation matters. And the truth is, as I said, 1 out of every 2 or 3 people is going to need some kind of care. It's about independence, it's about affordability, it's about dignity. If you don't plan for those 3 things, someone's going to end up deciding that for you. So the takeaway is it isn't fear, it's clarity. Long-term planning is about protecting income, preserving your legacy, keeping families from fracturing under stress. And this conversation, I love that she's addressing it. It's huge. And if you want some more information about how these types of conversations can come into play of a truly holistic area that includes some of the biggest areas that'll fleece your money, medical, college, etc., go visit us. We've got a new website, by the way. We've integrated. So if you go to mergentcollegeadvisors.com, it'll now take you to our new website at mergentadvisors.net. That's MERGENT, mergentadvisors.net. We don't sell products. We build structures that will make sure that care, cash flow, and family unity survive the long game. Go check out our new website.
That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.